Hello and welcome to the News Centre. I'm Shireen Bhan. India's private capex cycle wheel is turning and it could be at a high speed. A report by Goldman Sachs highlights that fresh investment announcements in the last fiscal jumped 145 to 150% compared to FY21 levels, a year that was ravaged by the COVID pandemic. The manufacturing sector has been the clear outlier with a 200% growth when it came to new investment announcements. While the increase was aided by mega project announcements, especially in the steel sector, traditional sectors like petchem, cement, automobiles and new age sectors like electronics, e-vehicles, data centers have also made a significant contribution. That's not all. The number of projects announced last fiscal was 80% higher than FY21. Well, joining me now to take the discussion forward on the Indian manufacturing sector and the road ahead is Ashish Bhandari, MD and CEO of Thermax, and B. Tyagarajan, the Managing Director of Blue Star. Gentlemen, appreciate you joining us here on CNBC TV 18. Ashish, let me start by getting a pulse check from you. We just gave our viewers a snapshot of what Goldman Sachs has highlighted. Clearly, the manufacturing sector is in the spotlight. And as Goldman has highlighted, sectors like steel have really driven the momentum so far. That's been a clear outperformer. But what's the sense that you get on the back of the order book that you're looking at on the back of the demand visibility that you have on the strength of the recovery and the turnaround in manufacturing?
Hi, Shireen. Very good evening to all your viewers. I think most of us would be in sync with the analysis that Goldman has made. We are seeing strength across multiple sectors. Demand is strong. That said, the commodity price increase is a dampener, and this particular effect has the potential to bring the entire growth story down in coming quarters. So right now, things are very good, but there are dark clouds on the horizon.
There are dark clouds on the horizon, so a word of caution there coming in from Ashish Bhandari. Mr. Tyagarajan, I want to address that issue with you. So far, we haven't seen an impact on demand, but as Ashish was pointing out, this is clearly a threat that is overhanging at this point in time. We have seen companies pass through the hikes that they've had to take on account of the rise in input costs. Do you see this slowing things down, or do you believe that this is going to in fact be far more disruptive when it comes to demand?
Really saying, I fully endorse what Ashish is saying with regard to the demand pickup. So one, as a company, if our own capex cycle has revived in a big way, what we should have invested a couple of years ago, it got delayed due to the pandemic. The second one is the main driver in manufacturing is the PLI schemes announced for various sectors. And we all believe that our export potential is high in the China plus one story and the global supply chain realignment program that every country is attempting. So therefore, Blue Star itself is investing in manufacturing. The Sri City plant and the Wada, another plant, something close to 400 crores of capital will be invested in this financial year. And so are my competitors. Other than that, in our electromechanical projects business, we are saddled with so many inquiries. The manufacturing sector, specifically what all you had listed, steel, it is there. And it is there in the automobile sector. It is there in some electronic component manufacturing or robotics, so on and so forth, data center, and most importantly, renewables related space like solar cells. So there is a hell of a lot of capital investments are taking place. Now, if I look at the B2C space, yes, despite the price increase, we increased the prices thrice last year. In April, in July, again in October, and the market demand stood up. Now, again in April, we have increased, so still the demand is good. So therefore, at some point of a time, I agree with Ashish, it is going to catch up with this. There are a few customers of ours who wanted to expand the manufacturing capacity at around 400 crores. Their revised cost estimate would have gone up. So they are getting the additional approvals to go ahead with the project, but still they are going ahead. So there is a lot of optimism in the marketplace. I am hoping that this current geopolitical crisis will cool down and the commodity prices will soften. Otherwise, this growth story is phenomenal. I have not seen this in the last 10 years.
You're saying you haven't seen this kind of demand in the last 10 years. And so far, despite the price increases, despite the hike in input costs, demand is holding. But Mr. Tyagarajan, I want to understand from you, you gave me that number of 400 crore rupees that you believe you are going to spend in terms of capex this year. Now, we saw on account of COVID, 2020 and 2021, 2020, of course, was a washout year. 2021 also to a large extent was a mediocre year when it comes to demand as well as the manufacturing sector's output. So 400 crores, what would have your annual capex been? And how does that then relate to this 400 crore number that you've just shared with me?
It would have been at around rupees 150 crores. And what we are foreseeing is that in about 3 years' time, furthermore, we may have to invest. So it is the demand that is growing. In order to fulfill the demand, you have to expand the capacity. This is where we are. And then the next part of the game is there is indigenization taking place, a component ecosystem. So therefore, backward integration investments are taking place. Third is, this is the important thing that I am understanding. Indian enterprises have understood scale is important for you to compete globally. And for you to compete locally, therefore, in order to build scale, you have to look at manufacturing differently. It cannot be assembly units. It has to be backward integrated. It has to be larger. And then the capital is available now. Access to capital, availability of capital, cost of capital is still attractive compared with what was in the past. So therefore, this is the important thing what the boards are thinking, that the company has to scale up, and then only they will get the cost advantage and competitive edge. And let us go ahead and do it. That's what is the root cause of this optimism.
Right. So you're saying boards are finding it easier to sign off on expansion plans at this point in time because, as you point out, access to capital freely available at this point in time, and cost of capital also makes fresh investments viable. But Ashish, I want to address that very same issue with you. What kind of capex are you looking at for the current year as well as over the next few years? And more importantly, in terms of order book, both domestic as well as export potential, because as Mr. Tyagarajan was pointing out, across different sectors at this point in time, companies are looking at being able to plug the gaps that are opening up on account of geopolitical realignments. What does that opportunity for you specifically and for Indian manufacturing in your assessment look like today?
Look, I would completely agree with what Tyag has said across multiple sectors. And initially, we saw food, pharma, chemicals pick up. In the last year or so, steel has come in, refining and petrochemical. Many of the government projects that were kind of during COVID times had slowed down a bit are now back in full swing. Not only that, the whole shift to finding alternate energy, making your existing energy basket more renewable, the pressure that is coming from increased coal prices, all of that. Yeah, demand is strong, no question. I would also agree entirely that the export environment is also conducive. Across many of our customers, they are reporting strong exports. And we too, from a Thermax point of view, exports were one of the later parts of our business where orders started to pick up, but they're clearly picking up on all fronts. Yeah, so no complaints on both of those. I would also agree that the overall debt situation, access to capital, all of it is overall debt in the market has come down and capital is still available at a reasonably cheap rate. So most would look at this environment as a good environment to invest. I think Tyag and I are in complete agreement, at least in our view towards what the market looks like.
Well, that's good to hear. But Mr. Tyagarajan, I want to come back again and address the issues that you raised in terms of making use of government schemes. The PLI scheme you talked about. And of course, what we had also seen pre-pandemic was the government's attempt to draw in investments by way of cutting corporate taxes, especially when it came to new projects and setting up new facilities. Now, there has been an extension granted on account of COVID to be able to avail of that. How significant do you believe that, both these measures, the PLI as well as the corporate tax cut, which couldn't fully be utilized through the course of the pandemic will come to the aid of the manufacturing sector?
I entirely agree that our own investments were subject to these that the new corporate tax rule for a new manufacturing facility plus the PLI scheme. But at the same time, I want to point out to you the PLI scheme, how it works. The investment is one axis. The other axis is the incremental sales. So you get your incentive not by producing. It is by, you have to show a incremental sales actually. So in that context, I keep advocating this, that the PLI goes eventually into the hands of the consumers. Because all of us have to show incremental sale over FY21, then only I will earn the incentive. Say, for example, in room air conditioners. So are my competitors. So everyone will have to be earning PLI only by incremental sales. So what is going to happen? They are going to compete, and in the process, scale will be built, prices will come down, or the products will become affordable, either through scale or through innovation or combination of both. And eventually this PLI which government has given is getting passed on to the consumers. And part of it comes back as the tax collections. So therefore, this is an important move the government has done, and it has triggered the industry. In case of air conditioner industry, in about 3 years, the capacity will double. If you go by the real investments that are taking place. And the imports are going to be reducing by around 70% compared with what it is today. So what government has done, they will get back much more than what it is. And there is going to be a phase where the penetration of air conditioners, which is somewhere around 7% today, will become somewhere around 10 to 12%. So you will witness a exponential growth in that sector. And I suppose in EMS or mobile phones or EV, all these are going to follow the same trajectory.
Well, that certainly is the hope, that we will see a secular rise across different sectors, as you point out. And the point well made there, that PLI is linked to incremental sales. And so you will only be able to avail of those benefits if you can, in fact, push your sales forward. And the government's stated objective is to bring down imports. And you're saying that you believe we are likely to see that happen over the next years across different sectors. Ashish, I want to address the issue with you in terms of where current utilization rates are for you specifically, and how soon you believe you will need to look at enhancing capacity.
Look, our current utilizations across our multiple plants, when we came out of COVID, we were at 60, 70%. Earlier, we crossed the 90% threshold. I think we can still increase capacity with our existing plants by being innovative, by leveraging our subcontractors, adding shifts, whatever the case may be. We will be active in terms of adding new capacity. We're building plants building plans to build plants in multiple of our product lines. We're also investing quite a bit on newer technology, whether it be digital, whether it be newer capabilities, R&D, all of it. I think, and I, as Tyag was saying, it's not just smattering of companies. I think the largest sector overall is gearing up to hit new levels.
Yes, and see a return of capex. But Mr. Tyagarajan, one of the other issues I want to address with you, and this is something that you've been working very closely with CII and the government on, labor codes. And of course, we haven't seen any forward movement on the implementation and the execution of that. But that aside, at this point in time, given the fact that you're setting up additional capacity and you believe that we're going to see that happen across the board, what will it mean in terms of incremental hiring as far as the manufacturing sector is concerned? And how much of a challenge is that today in terms of finding skilled manpower?
Huge challenge, not only labor, even the managerial manpower in be it R&D, manufacturing, sales and marketing. You have huge challenges. Right now, how it is managed is you are poaching from someone and you end up paying a higher salary. So it is good in one way. The employment problem is getting resolved. And on the other hand, you are also going to have a situation where you will be able to figure out other ways of employment. Say, for example, the fixed term employment part of it. it is something which got delayed by many states, and I think they all will relook at it. Right now, all are expanding with the hope that they will be able to find laborers and skilled laborers. It is going to be a challenge in about 18 months' time.
Okay, you believe that that will be a challenge. But for now, despite the turbulence that we are seeing, specifically on account of rising input costs, you believe the demand is strong and here to stay. Ashish Bhandari, Mr. Tyagarajan, always a pleasure. Appreciate you joining us here to take us through the road ahead for Indian manufacturing and the pickup in private capex that we are seeing in the manufacturing sector. Appreciate your time. We will take a break. Axis Bank reports